Hello again. So we're back to dissect some financial statements and make it really interesting. So I'm Ian Smith. I'm the owner of TheStrategySmith. I'm a management consultant and business coach. I'm going live on 5 platforms tonight. So I'm going live on LinkedIn, YouTube, Facebook, TikTok, and X, formerly known as Twitter. By all means, put some comments in the boxes, depending on which platform you're watching me from. I might not see them live on screen, but I always reply to all of the comments. So don't forget to like and subscribe and comment and send me your questions, depending on which platform you're watching from. So we've covered profitability, we've covered liquidity. Now we're going to cover leverage, and sometimes it's referred to as gearing, how a business is financed either by debt or equity, or essentially both. And so I'm going to cut through the balance sheet. We're going to update the structure in terms of the short-term liabilities. We're going to dip in to some P&L as well, some profit and loss too, although I won't be able to draw the full statement of profit and loss on the board today, but I'll be using some ratios that include elements that you would normally see on a profit and loss statement. And yesterday, if you want to go and catch the live version of the liquidity assessment based on the balance sheet. So I drew the balance sheet side by side. So assets on the left here, and also short and long-term liabilities and shareholders' equity. And the reason why it's called a balance sheet is because the total assets should balance with liabilities and equity. And that's a good indication also as to how the business is going to be financed either by debt and equity compared to the assets that are held within it. And I'll show you a quick ratio, not this quick ratio, but a ratio that you can do quickly to understand the total assets over the total owner's liability, and also the total liabilities over the assets. They'll give you the same story as to how much of the assets are funded by debt or equity. And I'll explain that in a second. So I'm going to take these off. These are the liquidity ratios that we covered in the previous live. So if you were to Google TheStrategySmith live liquidity, you'd be able to find it. Then I'm going to just smarten this up. So we covered current assets. I'm going to update this part of the balance sheet for current liabilities, and just to take into account some of the elements that we might want to look at in terms of how the business is financed. So we'll just give this a quick wipe. Get some more space here. And I'll just move it down. And we'll update the balance sheet just to show some more of the current liabilities. So short term means current liabilities. So in the current liabilities, you may have accounts payable. So things that you need to pay for. You might have some tax payable as well. You may also be paying interest, or you may be paying the current portion of your long-term debt that you want to highlight as a short-term or current liability. So when we covered liquidity yesterday, we'll just take these 6 and cross them off. When we covered liquidity in the previous live, we knew that we needed to have sufficient ready available assets that could be converted into cash to meet the short-term liabilities. And part of the short-term liabilities is serving or putting money into the long-term debt portion requirements. So this is, I'll just call it current portion of long-term debt. Get a new pen. Okay. So there are the main elements of the current liabilities. And then you have long-term liabilities. And then just as a dotted line, you've got shareholders' equity. Okay, so again, total assets need to balance with total liabilities plus shareholders' equity. And that gives you the firm value. So what we're going to look at is how, if a potential buyer of the business or a bank or an assessor or what have you, or if you want to check and link this back to your own ambitions to determine the part of the value of your business. This is quite a strategic way of doing it, is of course add in the other assessments of financial health, profitability, liquidity, gearing or solvency in this case. And the other element which we'll cover in another live is asset management, how you can convert assets in the business into profit and run the business like that. And so what you're able to look at here by dissecting the balance sheet and understand how this business is financed, you're able to make quite strategic decisions based on what you want success to look like for you and for the business. So if, for example, you needed to lend some money, a long-term lender will look at how the business is financed versus debt and equity. So if, for example, there's a lot of debt already in the business, short and long term, and not so much equity, then they're going to look at that as a high risk because there's already the debt to serve in terms of the current liabilities, long-term liabilities, and there's not sufficient equity financing the rest of the business. And then what they'll look at from there is likely how liquid the business is, and also how profitable the business is, and then we'll look at the assets as well. We've covered profitability, liquidity, and solvency later because I wanted to do the P&L and the balance sheets, and we'll cover some cash flow and things like that later as well. So one of the ratios you're able to look at is looking at the total assets divided by the total owner's equity, or show a similar story, the total liabilities over the total amount of assets. And what that means is, if I just draw this for you, total assets over shareholders' equity if, for example, the total amount of assets, so don't forget, this total amount of assets is equal to short-term liabilities and shareholders' equity, then if we make this calculation, what this means is that this amount of equity is financing this amount of assets. Same thing as if we divide liabilities, total liabilities, with total assets. This amount of debt in the business is financing this amount of assets within the business. So if a bank looks at your business, or you want to take out some form of loan, or you want to literally increase the value of your business, because we talked about yesterday, this will affect the discount factor that's calculated. Part of your gearing is something that's quite a tactical, strategic element to focus on. Is if you have sufficient equity above or a reasonable balance of how much debt your assets are financed, then you're a better risk because you've got more equity serving financing the assets and the cyclical production of profit and loss coming back through to the business, which then results in more shareholders' equity, etc. Then you're a much better risk. So, say for example, your total assets here equals 6, and your shareholders' equity equals 1. So 6 million, 1 million shareholders' equity. What that means is for 6 million worth of assets, 1 million of shareholders' equity is financing it. And then 5 million of liabilities must be financing it, because the total amount of assets must be equal to the total liabilities plus shareholders' equity. So that means that if 1 million is here, then 5 must be here, because all of this equals 6 million. And then these two should balance 6 and 6. Oops, that's not to 6. So that means you've got 5 million debt financing 6 million assets, 1 million shareholders' equity financing 6 million of assets. So that's a good indication as to the level of financing compared to the assets within the business. Now, another good ratio, we'll leave that one on there and we'll draw another one over here. Another good ratio is looking at the gearing of the business. And that takes into account the total liabilities divided by, the total debt plus equity in the business. So what that means is it takes total liabilities divided by the total liabilities plus equity, which gives you a percentage. So going back to the 5 and 1, if we say debt over debt plus equity, that's equal to 5 plus 1, divided by 5 plus 1. So that's 5 over 6 as a percentage. So that means that there'll be Texas Instruments calculator, 5 over 6. So that means it's 83% financed by debt, and therefore, because that's a divisible over each other, 83%, then it is 17% funded by 16.6. 17, so 16% funded by equity. So that works out at 83.3, and this works out, and that's recurring, that's 16.6 recurring, so we're a basis point out. And that tells you then that this business, if it has 6 million in assets, which must be equal to total amount of debt plus equity, this 6 million of assets is 83.3% financed by debt and 16.6% financed by equity. So that's the gearing ratio. Now, the reason why businesses are a better risk if they are public is because you can take the market value of equity, which could be different to what's being retained as shareholders' equity in the balance sheet. Market value of equity takes on the number of shares in circulation, i.e. floating, and the value of each share. So when a bank is going to, especially with long-term debt, if a lender is looking at a business in terms of long-term debt for a public company, and it's a big chunk of money, this is one of the ratios that they will use. How much debt is financing the business, but also how much of the shareholders' equity market value is financing the business. So people who are shareholders are financing the company. So the bank or the lender will take that into account as well. So the debt to equity ratio for a publicly traded business is a much better risk than potentially a private company that is, in this case, more funded by debt than equity. If this was a public company, this would put this ratio up if it was the market value of equity. because there will be more equity in circulation that's financing the business, and the bank will take that into account when making a long-term lending calculation. So we've done the gearing. Now we've done how much a business is leveraged. So yesterday I talked about the weighted average cost of capital calculation. And this is why I say that these are quite tactical and strategic moves that you're able to focus on. Because if a dollar or a pound is worth more in the business than it is giving it to shareholders as a dividend, for example, in this case, retaining shareholders' equity to maybe fund capex and things like that to increase the value of a business, that means that money left in the business is more valuable than releasing it out to the shareholders, as an example. So a good example of this was Shell. Shell released a scrip dividend, which was an increase in shares rather than a monetary dividend. In my opinion, that protected their cost of equity when they were wanting to make big investments, leveraging cash cow service lines, business lines. We don't need to go into what they were, but I know what they were, and I know what they funded, which was greener innovation and renewable tech, etc. And they're just going after innovation. But point being is, when you look at your gearing, it's a big factor in the weighted average cost of capital of a business, which is used as a discount factor to bring your forecasted future cash flows to the present value. So if your cost of debt is higher, it means that you either need to negotiate a better deal on your debt, but likely is the cost of debt to this business being funded 83.3% of debt will be much higher if it was flipped, because we've got long-term debt, we've got short-term liabilities, current portion of long-term debt to be paid as well. The interest and the cost of debt to this business will be much higher. And if that's higher, then it takes this ratio to 83% in terms of the leverage of the business. So when you calculate the weighted average cost of capital, you take into account the cost of debt, corporate tax, and you add that to the gearing, or multiply that by the gearing. Then you add that to the cost of equity and how the business is geared and financed in terms of equity. So it's this calculation. We'll show you equity over debt plus equity. So it's exactly the same, only you're taking the 1 here and the 5 plus 1 there. And it will show you here that 16.6% instead of 83.3%. Then you take into account the cost of equity, which looks at dividends and can look at equity betas and capital asset pricing models and things like that. But the main point is waffling. Main point is looking at the gearing and deciding how much you want your business to be leveraged by debt or equity, depending on the assets. So total assets over shareholders' equity, that gives you the indication of this total amount of assets funded by the amount of equity. And if you were to flip that calculation, how much debt is funding these assets. Now, another way is I talked about at the beginning of this video how to dip into other statements to check the leverage and gearing, and essentially how the business is funded by debt. So if you look at the profit and loss, you have revenue, then you have cost of goods sold or cost of sales, then you've got your gross profit, then you've got your expenses, then you've got your EBITDA, then you've got your depreciation and amortization or what have you, and then you've got your EBIT, then you've got the interest, then you've got profit before tax, then profit after tax, and then that's the firm's profit. EBIT, earnings before interest and tax. So by looking at the profit and loss, also cash flow, and the current portion of debt, you can make a calculation as to the interest rate that the business is paying on its debt. Now, if you were to take the ratio of EBIT over interest rate, that gives a really good indication of the profitability, but also the long-term viability of the business. And it's almost a gearing and a liquidity profitability assessment just by looking at, is there sufficient EBIT, earnings before interest and tax, to satisfy the interest rates that you're paying on the debt. So almost like the quick ratio and the current ratio that we looked at in terms of liquidity, but we looked at short-term liabilities, this focuses on earnings before interest and tax to satisfy the interest rate, because EBITDA is what's known as the firm's profit. And it's the firm's profit that is left over for the rest of the company's, because it's a going concern, the rest of the company's ability to satisfy its interest and tax commitments and essentially run the business. So EBITDA with depreciation, fund its assets and depreciate its assets, things like that. So EBIT over the interest rate tests the long-term viability of the debt that's within the company. Because if this interest rate is high and there's not sufficient EBIT to satisfy it, or that ratio is low, then it puts things into question as to the financing, not just how much it's leveraged, but the actual terms of the financing and interest rates and things like that as well. So now we're going to look at, we're going to calculate, again, looking at the profit and loss, we're going to calculate how much the business is reliant on debt from its suppliers. And the way that you're able to calculate that is we look at accounts payable. So accounts payable is essentially the suppliers that the business needs to pay. So they'll have suppliers that they'll need to pay goods for, and hence going back to the profit and loss, cost of goods sold, those costs should be going to the suppliers. Now, it's difficult to, unless it's specified, it's difficult to see specifically annual purchases, because cost of goods sold is sometimes grouped with purchasing materials and stock and things like that, but also people's salaries and things who are attributed to the sales. But you can look at cost of goods sold and calculate it in such a way as to how many days that are left for you to pay your suppliers. So what that means is you're essentially on credit for a certain amount of days to pay your suppliers, and therefore your suppliers financing some of your assets within the business. So we look at accounts, so annual cost of goods sold or annual purchases, if you can find it in the P&L, or if you're allocating it in the P&L, accounting for it. So first we look at annual purchases. Over 365. Make sure you can all still see that. You can. Great. Annual purchase over 365, and what that means is per day how much you're spending on cost of goods sold, or ideally purchases. And then you take this number here, which gives you how much you're spending per day, and divide it by accounts payable. So you take this and then you can divide it by accounts payable. And that will give you number of days that you're not paying your suppliers. Yes, number of days that you're not paying your suppliers, because you will get a number of number of days of purchases divided by 365, and then take that in terms of the average purchases per day, and it demonstrates how much the business is dependent upon the supplier's lending. And that's essential, because it's not just the debt that's allocated here, it's the debt that's not necessarily inside the balance sheet, but you are able to find it by looking at accounts payable and annual purchases. So what essentially you're doing is you're able to allocate the days of purchases that have been left unpaid. And that gives you the idea of the suppliers lending into the business as well. So not just how the business is financed through banks and lending and other things like that, the suppliers are financing the business too. And that's essentially leverage, how the business is financed through debt and equity to fund its assets. That's why it's called the balance sheet, because total assets should balance with your total liabilities plus the equity, the shareholders' equity. When you're looking at gearing for a private company that doesn't have shares, you'll take what's called the book value, which is if you're looking at it from something that's not publicised, or if you go on in the UK, it's like in the US it's the SEC, here it's the Companies House, what's been last reported, retained equity, shareholders' equity, compared to the total debt within the business. If a lender is looking at a public company, they can look at the market value of the shareholders' equity as well, which allows you to assess the level of financing from shareholders in terms of equity also. And then you flip that if you want to look at the WACC calculation, weighted average cost of capital, because that's needed to understand comparing it to the cost of equity within the business. Then you can look at the debt side, which is the cost of borrowing to the business, take into account corporation tax and things like that within the country. Total assets over total shareholders' equity gives the same ratio, or tells the same story as debt over debt plus equity, because this should balance. And these two, when added together, should be equal to total assets. And so, to kind of summarize the gearing and the leverage ratio as to how a business is funded by debt or equity, you're able to see quite quickly how much debt you're willing to take on compared to the value of the assets that are within the company. And have you taken on good debt that's allowed you to reinvest and grow the business? And that has come round full circle, that has allowed you to retire some debt or grow the business even further, so that the debt has remained the same, but the equity has increased, and therefore the ratios are balancing each other out a little bit more. Assets have increased in value, equity has increased in value, debt stayed the same. And you're able to make these long-term strategies to increase the value of your business. You can look at, just by dissecting the balance sheet in this way, using these calculations, you can look at it from a lender's perspective, look at it from a buyer's perspective, look at it from someone who wants to sell their business perspective, and then put in place short and long-term strategies to execute and nail the growth of your business. So that's the balance sheet. So we've done the profit and loss, we've done the balance sheet, we've covered profitability, liquidity, and solvency. I'll take a look at asset management as well, and give you some key ratios there to see how productive your business is being, and enjoy. So you can use these ratios yourself. If you look at your own balance sheets, Do the debt over debt plus equity ratio. You'll get a good indication as to how much of your business is being financed by debt or equity. Have a look at the EBIT over interest rate to see the viability of the debt that you've got in the business and the profitability that you've got in the business. And then another good ratio is to see how your suppliers are financing your business, how much you're dependent upon suppliers lending. Because if that business was to change hands, for example, then if it's dependent upon suppliers lending, then it could offer quite a significant risk to the potential buyer, or an opportunity, depending on which way you wanted to look at it. So enjoy balance sheets, fun. Right, have a good evening. I will be at an event tomorrow, so it might be Friday or next week when we do asset management. But I hope you've enjoyed the balance sheet and leverage ratios. Have a good evening.